In this video, we are going to explain what America's exploding debt really means, why global financial institutions are quietly moving trillions of dollars right now, how this exact situation has happened before in history, and why the same mathematical pattern that destroyed past empires is unfolding again today. We will walk through the stages of economic collapse, examine real historical examples, and show you what this means for you personally, starting now. Part 1. Debt, Power, and the First Cracks in Great Empires. Today, the global economy revolves around a single number, not a battle date. Not the founding year of an empire, not a population statistic. That number is trillions of dollars in sovereign debt, and it is not unique to any one country, because this story does not begin with modern America. It begins with a pattern that has repeated itself every time a great power tried to rule the world through money instead of limits. History teaches us one brutal lesson: a state can manage power, or it can manage debt. It cannot do both forever. At first, debt feels like a tool, then it becomes a habit. Eventually, it becomes a necessity. And once debt becomes necessary, collapse stops being a question of if, and becomes a question of when. Why debt works. At first, every rising empire needs three things to expand: military force, administrative control, economic momentum. In the early phase, these reinforce each other. Territory expands, taxes increase, trade grows, confidence rises. But expansion always slows. Borders stabilize, returns diminish. Spending, however, does not slow down. Armies must still be paid. Infrastructure must still be maintained. Prestige must still be defended. This is the moment debt enters the system. Debt tells rulers something seductive: you don't have to pay the price today. And throughout history, no great power has ever resisted that promise. The repeating four-stage model of empires. Across centuries and continents, dominant states follow the same financial arc. Stage 1. Production and expansion. Stage 2. Growth financed by debt. Stage 3. Monetary manipulation and financial engineering. Stage 4. Loss of confidence and systemic breakdown. This is not theory, it is observable history. Spain, the Dutch Republic, the British Empire, and eventually, the modern world. To understand how this cycle begins, we start with one of the clearest early examples: Spain. Rich in gold, poor in structure. In the 16th century, Spain became the most powerful empire on earth. Silver and gold poured in from the Americas. Treasure fleets crossed the Atlantic. The Spanish crown controlled resources no European state had ever seen before. But there was a problem. Spain's wealth came from extraction, not production. It imported manufactured goods instead of building industry. It relied on future shipments instead of domestic efficiency. It funded wars based on expected treasure that had not yet arrived. The Spanish monarchy borrowed aggressively against future gold. These loans were the ancestors of modern sovereign debt. And when silver shipments slowed, the system broke. Spain declared bankruptcy multiple times between the 1500s and 1600s. Yet the empire did not collapse overnight. Why? Because debt can delay collapse, but it can never prevent it. Why? Debt buys time but never solutions. Debt creates breathing room, time to reform, time to restructure, time to adapt. But most empires waste that time. They do not reform spending. They do not rebuild productivity. They simply borrow again. Spain did exactly this. Each new loan covered the last. Each new shipment patched old deficits. Each war was justified by the next expected influx of wealth. But an economy that does not produce cannot sustain infinite obligations. Eventually, creditors stop believing the promises, and belief is the real foundation of financial systems. This is not an ancient problem. Modern economies like to believe they are different, more advanced, more complex, more rational. But the mechanics have not changed. Gold ships have been replaced by bond markets, royal treasuries by central banks, physical coin by digital balance sheets. The core question remains exactly the same: how long can a state spend more than it produces? The handoff of power. Spain declined. But the world did not stop. Power passed to a new kind of state: smaller, more disciplined, obsessed with trade instead of conquest. This next power did not reject debt, it weaponized it. But before debt became a global financial system, another empire mastered something even more important: cash flow. In the next part, we move away from collapsing monarchies and toward a state that turned finance into an operating system. This is where money stopped being a resource and became a strategy. This is the rise of the Dutch Republic. Part 2. The pattern repeats. In the first part of this video, we established something critical. What you are witnessing today is not random, and it is not unprecedented. It is a pattern, a recurring financial cycle that has shaped the rise and fall of empires for over 5 centuries. Now, in this part, we are going to prove that pattern beyond any reasonable doubt. We are going to walk through history, not in vague terms, not in metaphors, but step by step, using real empires, real currencies, real balance sheets, and real consequences. Because once you see this pattern clearly, you can never unsee it. And more importantly, once you recognize where we are in the cycle today, the current moment stops feeling confusing and starts feeling disturbingly familiar. Let's begin with the first modern global superpower, 16th century Spain. In the early 1500s, Spain was not just wealthy, it was unimaginably powerful. There was no rival, no close second. Spanish fleets returned from the Americas carrying more gold and silver than the world had ever seen. Entire mountain ranges of precious metal were stripped and shipped back to Europe. The Spanish real became the backbone of global trade. If you wanted to buy, sell, insure, or finance anything across borders, you needed Spanish currency. Madrid was the financial heart of the known world. This was stage 1 in its purest form. Capital flooded in. Confidence was absolute. The future looked limitless. Spain controlled vast territories across Europe, the Americas, Africa, and Asia. Its armies were feared. Its navy dominated the seas. Its king, Philip II, ruled over what was effectively the world's first true global empire. And with that dominance came a dangerous assumption that it could never end. So Spain began to spend, not carefully, not strategically, but endlessly. Wars across Europe, wars against England, wars against France, wars against the Ottomans, wars in the Netherlands, massive military garrisons on multiple continents. A sprawling bureaucracy, lavish royal courts, enormous religious institutions draining resources. By the mid-1500s, Spanish government spending exceeded revenue by 300%. Let that sink in. Spain was spending 3 times more than it collected in taxes. The difference was borrowed. Italian banks, German financiers, private lenders across Europe, all eager to lend, because Spain was Spain. Gold kept arriving from the New World, so nobody panicked. Asset prices rose. Confidence stayed high. The empire felt invincible. This was stage 2, overextension. And then, quietly, something changed. Not publicly, not politically, financially. By the 1550s, major Spanish banking families began relocating assets to Genoa. The Fugger family, Spain's largest creditors, demanded repayment not in promises, but in physical gold. Wealthy merchants shifted trade routes northward. Offices opened in Amsterdam. Capital slowly left Madrid. No headlines. No public warnings, just smart money reading balance sheets and seeing what others refused to see. Spain was functionally bankrupt. Interest rates on Spanish debt reached 40%. That is not strength. That is desperation. This was stage 3, the silent exodus. In 1557, Spain defaulted on its debt. Then again in 1560. Again in 1575. Again in 1596. Again in 1597. 4 defaults in 40 years. The currency collapsed. Inflation surged. The middle class was destroyed. Private gold was seized by the state. Trust evaporated. By the year 1600, Spain was no longer a superpower. Its golden age was over, permanently, and the money had already moved north to the Dutch Republic. Which brings us to the second example, 17th century Amsterdam. At its peak, Amsterdam was the richest city on earth, by an enormous margin. The Dutch East India Company became the most valuable corporation in history, worth the equivalent of over $8 trillion today. Dutch banks financed global trade. The first modern stock exchange was built there. The guilder became the world's reserve currency. If you wanted to do international business, you needed Dutch money. Capital poured in from everywhere. Asia, Africa, the Americas, all of Europe. Amsterdam became the financial engine of the world. This was stage 1, again. But just like Spain, success bred excess. The Dutch Republic entered a series of costly wars, with England, France, Spain. Military commitments stretched across the globe. Government debt exploded, increasing 20-fold in just 4 decades. To fund it, the Dutch printed money. Asset bubbles formed. Tulip mania took hold. Prices disconnected completely from reality. Meanwhile, the Bank of Amsterdam, supposedly the safest institution in Europe, secretly began lending depositor funds to finance government spending. A hidden fractional reserve system, a quiet financial time bomb. By the late 1600s, insiders knew the truth, and they acted. Major banking families relocated to London. Jewish merchant networks moved operations to England. Capital flowed out, slowly but relentlessly. The public had no idea. This was stage 3, once again. When the system finally broke, it broke fast. The Bank of Amsterdam collapsed. The guilder lost credibility. The Dutch Republic fell to foreign invasion. Riots erupted. Depositors lost everything. The Dutch Golden Age ended, abruptly. And once again, the capital had already moved to Britain, which brings us to the third and most important example. The British Empire. From the 18th through the early 20th century, Britain dominated the world. At its height, it controlled nearly a quarter of the global population and landmass. The pound sterling was the global reserve currency for over 200 years. London was the center of world finance. If you needed capital for anything, anywhere, you went to London. This was stage 1 at its peak. But 2 world wars changed everything. Britain financed those wars through debt. Government debt soared from 30% of GDP to over 130%. Sound familiar? The gold standard failed. Printing increased. Inflation rose. Britain technically won World War II, but financially, it was ruined. And then, quietly, the same thing happened again. Corporations shifted investment to America. Wealthy families moved assets abroad. Talent followed opportunity. Foreign investment collapsed. This was stage 3. In 1967, the pound was devalued overnight. In 1976, Britain was forced to seek an IMF bailout. The pound lost reserve currency status. The empire's financial dominance ended forever. 3 empires, 3 reserve currencies, 500 years, same 4 stages, same outcome. And now, for the first time, the pattern points directly at us. In Part 3, we will connect this historical cycle to the modern United States, step by step, and explain exactly why the current moment aligns so precisely with Stage 3. Not speculation, not ideology, data, and what that means for what comes next. Part 3, America and the Final Stage. Now that we have established the pattern, not as theory, not as opinion, but as documented historical fact, it is time to bring the story into the present, because the most uncomfortable truth of all is this: the United States is not outside this cycle, it is inside it, and, by every measurable indicator, it has already moved beyond the early phases. To understand why, we need to rewind to the moment America assumed the role once held by Spain, the Dutch Republic, and Britain. The year was 1944. The Bretton Woods Agreement reshaped the global financial system. The US dollar became the world's reserve currency, backed by gold at $35 per ounce. Other currencies were pegged to the dollar. Global trade, finance, and reserves flowed through American institutions. The timing could not have been more perfect. Europe was devastated by war. Asia lay in ruins. America emerged not just victorious, but industrially intact, financially dominant, and politically powerful. Capital flooded in. U.S. markets became the deepest and most liquid in the world. Treasury bonds were considered the safest asset on earth. The dollar became synonymous with stability. This was stage 1. From 1945 to 1971, America experienced an unprecedented period of growth. Manufacturing boomed. Wages rose alongside productivity. Infrastructure expanded. Confidence in the system was absolute. But then came the moment that changed everything. August 15, 1971, President Richard Nixon ended dollar convertibility to gold. In a single decision, the dollar became a pure fiat currency, backed not by a tangible asset, but by trust alone. And when you remove limits, behavior changes. Government spending expanded rapidly. Deficits became normalized. Debt began to compound. In 1980, U.S. national debt stood at just under $1 trillion. By 1990, it reached $3 trillion. By 2000, $5.6 trillion. By 2008, $10 trillion. By 2020, $27 trillion. By December 2025, over $38 trillion. That is a 4,200% increase in less than half a century. And that is only government debt. Corporate debt surged past $13 trillion. Household debt exceeded $18 trillion. Student loans, credit cards, auto loans, medical debt, all expanded simultaneously. Total U.S. debt crossed $100 trillion, reaching nearly 400% of GDP. For historical context, Spain defaulted at roughly 200%. The Dutch Republic collapsed near 250%. Britain lost reserve status at 130%. America stands far beyond them. This was stage 2, overextension. Asset prices soared. Stock markets hit record highs. Housing prices exploded. Valuations detached from fundamentals. The Federal Reserve intervened repeatedly, expanding its balance sheet from $800 billion in 2008 to $9 trillion by 2022. Money printing became policy, and then came inflation, not as a temporary spike, but as a structural consequence of decades of excess. Now comes the most important part of the cycle. Stage 3, the silent exodus. This phase does not begin with panic. It begins with repositioning. China once held over $1 trillion in U.S. treasuries. Today, it holds hundreds of billions less. Japan, the largest foreign holder, has steadily reduced its exposure. Saudi Arabia, Switzerland, France, Belgium, all have trimmed positions. These are not emotional decisions. They are balance sheet decisions. At the same time, major financial institutions have quietly adjusted portfolios. Asset managers have increased allocations to commodities, infrastructure, emerging markets, and gold. Exposure to long-duration U.S. debt has been reduced. The Federal Reserve itself has begun quantitative tightening, allowing bonds to mature without replacement. Ask yourself this question: if the system were strong, why would the system's own architects be pulling liquidity out? Who is buying U.S. debt now? Increasingly, the answer is the U.S. government itself. Circular financing, printing money to purchase its own obligations. This is not confidence, this is necessity. Meanwhile, global trade patterns are shifting. Bilateral agreements bypass the dollar. Alternative payment systems emerge. Energy transactions explore non-dollar settlements. This is not the end of the dollar, but it is the erosion of exclusivity. And history tells us what comes next. When reserve currency demand declines, excess currency returns home. Inflation accelerates. The central bank faces an impossible choice: raise rates sharply, making debt unpayable and triggering collapse, or continue printing, destroying purchasing power and confidence. There is no painless option. This is stage 4, and it never arrives gently. Currencies lose status gradually, then suddenly. Asset prices fall together. Banks fail. Pension systems strain. Middle-class wealth evaporates, not because of moral failure, but because of mathematical inevitability. Every empire believes it is different. Spain believed it. The Dutch believed it. Britain believed it. America believes it. History has never rewarded that belief. This does not mean tomorrow brings collapse. It means the trajectory is set. And in moments like this, survival is not about fear, it is about awareness. Those who recognize the pattern early preserve optionality. They diversify. They reduce leverage. They prioritize liquidity. They invest in skills, adaptability, and real value. Because when the system resets, paper promises vanish, but competence, trust, and preparedness endure. This is not prophecy. This is pattern recognition. 500 years of financial history pointing to the same conclusion. The cycle does not care about narratives. It does not require belief. It does not wait for permission. It unfolds. And the only real question is whether you will recognize where we are, or whether, like so many before, you will only understand it once it has already passed.